ever noticed how the market knows exactly when to fool you? Like the moment you buy, it drops. The moment you sell, it flies. Almost like someone is watching you. Well, someone is. This is not luck, it is not coincidence, it is design. Today I will show you the hidden game plan of the richest traders and institutions. The smart money blueprint. The system that makes you think you are winning right before they take everything. So who are they really? They are not the random rich guys. They are the FIIs, DIIs, prop desk, the guy sitting inside glass towers at Nariman Point or Singapore, moving crores with a single click. They control liquidity, headlines, and your emotions. Think about it. When FIIs sell 2000 crores worth of stock in a day, retail panics. But 2 weeks later, they quietly buy back the same stock 5% cheaper. You didn't lose to volatility, you lost to strategy. And the worst part, they don't just predict the market, they create it. Here's the exact 4-step blueprint smart money uses, the same one they have used for decades. Step 1. Accumulation. They start slow, silent buying across multiple brokers while news channel says nothing interesting here. You scroll past it bored and they are loading up. Remember IRCTC before its rally? Volume was building quietly for weeks. That was not retail. That was smart money preparing the trap. Step 2. Narrative launch. Then comes the story. News leaks, YouTube thumbnails screams, government policy boost. Telegram groups go crazy. That's not coincidence. That's narrative engineering. They plant the idea and you water it with your greed. Step 3. The pump. Now they stop buying. They start selling into your euphoria. Prices rises fast. Everyone wants a piece. Your friend calls, bro, buy now or regret later. But smart money is exiting quietly. Step 4. The collapse. Bad earnings, negative tweets, media panic, price tanks. Retail dumps everything in fear. Guess who's buying at the bottom? Yep, the same people. The cycle restarts. They don't manipulate stocks. They manipulate you. Let's take some real example of Indian stocks. Take Yes Bank. From 400 rupees to 10 rupees. Panic, rumor, sell-offs, FII dumped first. Retailers followed. Then those same institutions quietly re-entered when the chaos ended. Or PC Jewelers went up 300%, crashed 80%. Telegram tips, fake big orders, news, the entire thing was a coordinated pump and dump. But the scariest part, none of this is illegal if done quietly. It's psychological warfare dressed as market activity. Smart money is not playing the market, they are playing you. They know when you will panic. They know what kind of news will make you click buy. They know your fear of missing out better than yourself. When you see up 20% today, your brain says opportunity. Theirs says exit liquidity. When you see red candles, you see fear. They see discount. This is not about IQ, it's about EQ, emotional quotient. They profit from your impatience. The longer you can stay calm, the closer you get to their level. If you want to win in this profession, you have to start thinking like them. But how do we do that? Now let's get real. You can't fight smart money with inside information. You have to fight them by understanding the structure. So let me show you 2 powerful lenses that can literally change the way you read the market forever. First, track delivery volume, the hidden footprints of smart money. Every day, lakhs of shares trade, but only delivery volume tells how many were actually taken home. Intraday buying and selling is noise. Delivery is conviction. So if price is rising, volume is expanding, and delivery percentage stays high, that's accumulation. For example, HDFC Bank moves from 1400 to 1470 in a week. Volume doubles. Delivery holds near 65 to 70%. That's not traders scalping a move. That's funds building a position. Flip it. Price up, delivery collapses to 15 to 20%. That's retail money, not smart money. Smart money can increase the volume intraday by buying and selling at the same time. But he cannot fake the delivery percentage because delivery percentage adds overnight risk. You can check delivery data on NSE daily. Quiet rises plus high delivery means you have to pay attention. Loud spikes plus low delivery means you have to be cautious. Second step, learn Wyckoff, the operator's playbook. Wyckoff has 4 phases. Phase 1, accumulation. Sideways range, sudden high volume up bars, lazy volumes down bars. Operators absorb supply. Example, Tata Motors 22 basing action before the run. Phase 2, markup. Now the trend begins. Headlines turn bullish and public notice late. Phase 3, distribution. Rising but tired. Up days lose volume, down days hit hard. That's exit in slow motion. Phase 4, markdown. Story breaks. price falls, retail capitulates, operator reload lower. For example, Adani Enterprise in early 2023, everyone was buying the stock. And then what happened? Suddenly bad news started coming and price tanks. Wick-off is not a pattern. It's psychology mapped onto price. Combine delivery percentage plus wick-off. You will spot accumulation when others are bored and distribution when others are excited. Keep these two things in mind as well. Avoid chasing green candles. If it's trending everywhere, it is already too late. Zoom out. Smart money works in months. Retail dies in minutes. When you act less like a gambler and more like a detective, you will stop being their prey and start being their mirror. Next time you trade, ask yourself, am I reacting or am I being played? Because if you don't learn the smart money blueprint, you will always be the liquidity they exit on.